Why the US dollar keeps losing value is a question most Americans never stop to ask, because they are constantly told they don't need to. The dollar is global. The dollar is powerful. The dollar is the world's reserve currency. Those statements are repeated so often that they sound like facts carved into stone. But history has a way of humbling every currency that mistakes dominance for permanence. Being global has never been a guarantee of lasting value. In fact, many of history's most dominant currencies collapsed precisely because people believed they were untouchable. For most of modern American history, the dollar was not just paper, it was a promise tied to something real. Until 1971, every dollar was ultimately anchored to gold. You could not create unlimited money because gold itself was limited. That constraint forced discipline. Governments had to think carefully before spending, borrowing, or fighting wars. When money is scarce, choices matter. When money can be created freely, consequences are delayed but never erased. In 1971, that constraint disappeared. President Richard Nixon ended the dollar's convertibility into gold, officially severing the last link between the U.S. currency and a physical anchor. From that moment forward, the dollar became what economists call a fiat currency. Its value no longer came from gold in a vault. It came from belief, confidence, trust in the U.S. government's ability to manage its finances responsibly. And from that day onward, the entire system quietly changed. At first, nothing seemed different. The bills looked the same. Prices did not explode overnight. Life went on. This is how monetary decay always begins, invisibly. Inflation rarely announces itself as a crisis in the early stages. It whispers. It shows up as slightly higher grocery bills, slightly higher rent, slightly higher tuition. People adapt, assuming the changes are temporary. But when money creation becomes the default solution to every problem, inflation stops being a side effect and becomes a feature. Every time the U.S. government runs a deficit, it must be financed. In theory, deficits are covered by issuing bonds. In reality, those bonds are increasingly absorbed by a financial system supported by the Federal Reserve. When the government spends more than it collects, new dollars are injected into the system. These dollars are not created to make citizens richer. They are created to make existing debt easier to pay. Inflation quietly reduces the real value of what the government owes. Debt doesn't disappear, it is diluted. This is why prices rise faster than wages. Wages are reactive. Money creation is proactive. By the time workers negotiate higher pay, the purchasing power of that raise has already been eaten away. The result is a slow squeeze that feels personal but is structural. Families work harder, save more, and yet feel poorer, not because they are failing, but because the measuring stick itself is shrinking. The middle class was once built on the assumption that saving money would protect the future. That assumption no longer holds. A dollar saved today is worth less tomorrow. Not dramatically less, not visibly less, but measurably less. Over time, that erosion compounds. A dollar in 1971 had the purchasing power of more than $6 today. The bills look identical. The number is the same. The value is not. That difference is not an accident. It is mathematics. Inflation is often framed as a mysterious force, driven by supply chains, corporations, or global events. But at its core, inflation is simple. When the supply of money grows faster than the supply of goods and services, prices must rise. There is no ideology in that statement. There is no politics. There is no conspiracy. It is arithmetic. When money is created without limit, its value must fall. Supporters of modern monetary policy argue that the dollar's global status protects it. Foreign governments hold dollars. International trade is settled in dollars. Oil is priced in dollars. All of this is true, but none of it guarantees stability. Global demand can slow decline, but it cannot stop it. Rome's silver coins were accepted across an empire that spanned continents. Britain's pound once ruled global trade. Their dominance did not save them from devaluation. It only delayed the reckoning. What makes the modern dollar different is scale. The United States is not just issuing currency for its own citizens. It supplies the world. That creates a strange paradox. Global demand allows the U.S. to run deficits that would cripple other nations. But it also exports inflation globally. When the dollar loses value, it affects every economy tied to it. This feedback loop creates temporary stability and long-term fragility. Every crisis accelerates the pattern. The financial crash of 2008 led to unprecedented money creation. The pandemic response dwarfed even that. Trillions of dollars were created in a matter of months. These actions were framed as emergency measures, but emergencies have a habit of becoming normal. Once markets and governments become accustomed to infinite liquidity, restraint becomes politically impossible. Any attempt to reverse course risks collapse. So the system moves forward, not because it is healthy, but because stopping is unthinkable. This is why the dollar isn't about to disappear, but the purchasing power you grew up with already has. Collapse does not require hyperinflation. It does not require wheelbarrows of cash, it only requires steady erosion. A slow, predictable decline that shifts wealth upward and drains it from those who hold their value in cash and wages. Inflation rewards debtors and asset holders. It punishes savers and workers. This is not a bug. It is how the system functions. When people hear that inflation is only 2 or 3%, it sounds harmless. But compounded over decades, it becomes devastating. 2% inflation cuts purchasing power in half over roughly 35 years. That means someone who saves diligently for retirement is quietly taxed every single year. Not by legislation, not by debate, by design. The hardest part for people to accept is that this system persists not because it is misunderstood, but because it is understood very well by those who benefit from it. Governments can promise benefits today and push costs into the future. Politicians can fund wars, bailouts, and programs without raising visible taxes. The bill is paid silently through devaluation. Inflation is the most effective tax ever invented because it feels like no one imposed it. This is why debates about spending rarely focus on currency integrity. Questioning money creation threatens the entire structure. If money must be scarce, choices must be honest. If money is unlimited, promises can be limitless until reality intervenes. The US dollar has not collapsed because confidence remains. But confidence is not infinite, it is borrowed from the future. History does not suggest that the dollar will vanish tomorrow. It suggests something more subtle and more dangerous. That the dollar will remain, while buying less every year. That people will work harder for diminishing returns. That wealth inequality will widen, not because of productivity, but because of proximity to newly created money. Those closest to the source benefit first. Those furthest away pay last, and pay the most. This is why the story of the dollar is not about panic, it is about awareness. Understanding that money is not neutral, it is a system. And systems shape outcomes whether people notice or not. The lie behind money is not that it will disappear. The lie is that it will protect you simply because it exists. The US dollar is still powerful, it is still global. But it is no longer stable in the way previous generations understood stability. And once purchasing power is lost, it does not return. Not through growth, not through optimism. Only through discipline, something no fiat system has ever maintained indefinitely. This is not a prediction, it is a pattern, and patterns do not care about beliefs.